of Wealthi. He's on the line from Sydney, Australia. Peter, thanks for being with us. We've known about the risk of slower growth and the possibility of a recession as the Fed leans into fighting inflation by raising interest rates. One of the things we've been waiting for is how the inflation narrative shows up in terms of corporate earnings. And I think today we got a little indication when Target now was forced to reduce its forecast for full-year operating income margins. Is this something we're going to see a lot more of as time goes on?
Thank you for having me. I absolutely think it will, because if you have a look at a lot of the larger listed companies, particularly in the US market, they benefit from operating leverage on the way up, but that operating leverage also impacts you on the way down. And so scale is a beautiful thing when everything's working in your favor, but it can just as easily come back and bite your earnings. And the big concern now is with inflation, we've moved from anecdotes to confirmation, economic confirmation at the corporate level. And a lot of these businesses are going to struggle because they have a relatively fixed type of exposure, revenue exposure. I mean, there are only so many products you can sell per store, per head. But your cost base, that cost base that has had almost little or negligent inflation over the past 20 or 30 years is now undergoing a huge shock. So I think a lot of these businesses with operating leverage and very limited pricing power are going to be impacted.
Yeah, well, we saw some pretty dramatic selling in the US over the last session, the S&P seeing its biggest drop in more than 2 years. So how are prices looking relative to earnings to you now, considering what you just said? Do we have a little bit more to run, maybe?
I think everybody's trying to understand now where the true earnings are in a higher inflation environment. It's not necessarily at the revenue line, because we know that employment's strong, unemployment is low. You can make assumptions around revenue growth for a business of that scale relatively easily. But what's the cost base? You know, what are those items that are really going to take off, that are going to double or triple? What's happening to wages, and where are wage expectations going to go? And just how long are we going to have to put up with rising energy costs, rising costs of doing business? So I think the market, until it has certainty over what the new realistic cost base is, not just for Target, but even for businesses like Amazon that have grown massively over the past 10 or 20 years because of operating leverage on the way up. You know, what happens next? A lot of analysts are running their discounted cash flow models and updating that SG&A line to something that is probably having to be more appropriate.
So the question then becomes, how many of those analysts have had firsthand experience in dealing with a higher inflation environment? Not many, I would argue. And once inflation does heat up, it's very, very difficult to get under control. We know what the Fed's trying to do right now. I think the pivot question becomes very interesting. Is there still a Fed put, do you think? Will they blink if the rate of change or the deceleration, or let me put it another way, the acceleration in lower valuations, if that accelerates, will it cause the Fed to rethink?
I think at some point, it's all about when that point occurs. So I think central banks are in a very, very confused position. If you take the Reserve Bank of Australia, for example, which is where we are, and I know monetary policy is very different in Australia than it is in the US, you've gone in the space of 6 months from one extreme to another. And what that's signaling to the market is central banks themselves might not necessarily know the answers. And there's a lot of uncertainty now building around monetary policy. We used to have a lot of trust in our central banks to be able to predict and forecast, and that trust is now completely eroding. So it's not necessarily what they say, but it's what they do.
Right.
And I think the market's now figuring out what are they actually going to do, and that's where there's confusion.
Peter, when we continue the conversation, let's talk China. Peter Esho from Wealthi, our guest here on Daybreak Asia. We'll look at market action and global news ahead here on the program. This is Bloomberg.
Peter, we were discussing some of the challenges faced by US equities at the moment. A lot of those challenges do not exist in China, but there is a completely different risk profile there. What do you consider when you're looking at opportunities in China?
I think it's a completely different market dynamic. If you have a look at the composition of the market, you have very different composition in terms of industrial sectors that contribute to the weighting of that market. You obviously have a very different market capitalization profile, and you have a different type of investor in terms of passive and active investor. And I think what we look at when we're trying to understand where China's going is we look at three things. We look at the copper price, which is very important, and it's something that I guess is a great aggregate in terms of industrial production and industrial demand. We look at the iron ore price. That's one of the benefits of being here in Australia. We are such a large iron ore exporter, and our fortunes are tied to iron ore. And we also have a look at the oil price and the volatility in the oil price. And all three of those industrial indicators are suggesting that while we are in a rising inflation environment, we're not necessarily seeing, China blowing out those three commodities in terms of their demand. So to me, that's what I look at.
The risk of slower growth and maybe even a recession has triggered an unwind in some long positions in the commodities markets. And I know that there's a lot in Australia that has to do with agricultural commodities. We had some heavy selling today in complexes across grains like soybeans, even wheat and corn. And we know the situation now as a result of war in Ukraine has put a lot of pressure, upward pressure on commodities prices. I'm curious to get your take on the pullback that we have seen recently. Is that related to leveraged positions at all, do you think?
I think agricultural commodities in general are more extreme in nature because they are very highly concentrated to a few large producers and exporters geographically and also at the corporate level. And everybody's trying to figure out the impact on the global food supply chain at the moment. I think we are live in that process where we're trying to figure out the disruption. And so the way we see it is that what are the other industrial commodities that provide indicators? So, for example, some of the large multinationals like BHP and Rio Tinto have recently been realigning their portfolios to fertilizer exposure, to potash and potassium, the things that are important feedstocks into the agricultural sector. I think in the US, you get a little bit of a better picture as to what's happening at the global food supply chain level through the exposures that you have, particularly around the grain exporters. And I think in the next sort of 2 quarters, we'll have a much better idea of what this shock looks like, whether it's overstated or understated.
So is this where you're putting money to work at the moment, mainly around the agriculture sector, or are there other sectors that you're looking at as well?
I think in terms of the way we're thinking as a group, we're thinking that at the moment we're in a rising interest rate environment, we're in a rising inflation environment, and there are 2 very important things. Anything with certainty is going to find favor. Anything we spoke about operating leverage previously, a few minutes ago, but I think anything with the opposite that doesn't have operating leverage to that extent and doesn't have those volatilities is perhaps going to be in more favor. So residential real estate as an asset class, because it isn't listed, because it is illiquid, and because it is sometimes boring and considered by many individual investors to be that, I think that's what makes it exciting and interesting in this kind of market. And then I think if you want to come outside of that and you're looking at listed exposure, anything with pricing power is going to be key. You're going to have a big divergence between price makers and price takers. And I think you saw that last week in the luxury brand space, particularly those brands in Europe. They are still continuing to grow despite the inflation pressures and the impact on demand. So any business, any listed exposure that has pricing power, I think is going to find favor. And the opposite is also true.
All right, Peter Esho, we'll have to leave it there, but thanks so much for joining us on Bloomberg Daybreak Asia. Peter Esho is co-founder of Wealthi, based here in Sydney.